there's a lot of talk around, data centers and AI these days, right? And a lot of investments happening in that space. So if you think about the logic, the diversification logic there is not only do you invest in sort of the core technology, which is the chips that on the hardware side that's delivering this, but then you want to have plays that are investing sort of on the software side. And then you also want to invest in the infrastructure that's actually delivering power to these systems so you can actually generate the output.
Hey everybody, welcome back to Break Free from Wall Street, where we help investors move beyond stocks, bonds, mutual funds, and the public markets and learn more about how capital is actually being deployed in real innovative places like public markets and other alternative assets. Today, we're very lucky and fortunate to be able to be joined by Rakesh Radha-Krishnan. He is the founder and managing partner at Prithvi Ventures, where he leads investments in robotics, embedded systems, deep tech, and really on the frontier of innovation over there. Rakesh has really built and actually scaled companies. And now it sounds like, Rakesh, that you back founders, helping them, build the next generation of tech.
Yes, that's right, Nick. So just to clarify, I am not the founder of Prithvi. The founder of Prithvi is Kunal Sethi, who's our general partner out of New York, and Vivek Soni, who was our first operating partner, who was based out of Boston. So Kunal came from the banking side and had a history of venture investing, angel investing as well, and Vivek was originally the operating partner, kind of bringing more of the industrial expertise. So myself, Rakesh, Radhakrishnan, I obviously joined about a year and a half ago, along with another one of our operating partners, Murli Sethumadhavan, to essentially help manage some of the existing investments of the portfolio and then help with our second fund and making investments through Fund 2. Prithvi, by the way, for anyone who's interested, in Sanskrit means earth. And so we are a climate and energy focused fund that invests in super early stage, hyper ambitious startups in that space that's essentially looking to disrupt the industrial sector in many ways. And we say climate and energy because we don't think those are mutually exclusive. And so we invest across the board in all things energy related.
Absolutely. Yeah, those for sure I think go hand in hand. Really, really again, grateful for your time today. Just getting right into it, I think most of our listeners and most investors in general grow up with the idea of with your investment strategy, you have the Wall Street playbook, stocks, bonds, mutual funds, ETFs. Um, but you've been exclusively part of a very different trajectory with your experience in deep tech and your experience with the private markets and private investing.
Yeah.
Um, Tell us about what led you to that path or kind of the steps you took to kind of get into that world.
Sounds yeah, great question. So, I mean, I'll begin with sort of my background. So, 25 plus years in the energy industry. So, I'm a research and product development guy by training. Got my PhD at Virginia Tech in chemical engineering. Started out in a standard research and product development function at a large corporate. At the time, was called United Technologies. Now it's Raytheon. So involved in high risk R&D across several types of products. In the very early stages of my career. Then I progressed through the ranks. Got my business degree and transitioned into more of a consulting capacity, where I was supporting private and public sector clients make investment decisions across sort of energy portfolios. I did that for about 5 years, and then spent a little over 5 years back in the corporate world at Saudi Aramco, the largest energy company on the planet, helping them with a couple of mega projects and business strategy there. And finally, a stint at the Department of Energy at Advanced Research Project Agency for Energy. That was essentially the moonshot agency investing in energy tech within the Department of Energy. And so throughout that journey, especially, even in the large corporate world, early on in my time period, I used to interact a lot with startup companies in the energy space, right? And so of course in consulting, that's how the Aramco, and then certainly at Department of Energy, where I was really hyper focused on working with startup founders to help commercialize their tech. Got to see the ins and outs of private markets, because private markets are really some of the initial funding sources for these companies, so that they can kind of start building the company, scaling the company, and then ultimately when they're ready for a larger capital raise, hopefully they go public, potentially get acquired, etc. I think the number one thing that I would say is, if you're investing in the industrial sector in general in any publicly traded company, you are investing in high risk R&D. Some of the dollars that are you're actually investing, and if you think about it, those companies are spending um, dollars on research and development to develop new products. That's part of the way in which you get some of the growth in those companies. So it's not just you know making widgets, it's always creating that new widget, right? So I think you're getting a little bit of exposure here. But when you go to private markets, of course, obviously you get to um, go in at the ground level of a company, right? Just as it's forming. So you can think about like investing in Apple in those very early stages when it was out of a garage, right? A lot of the stuff that we look at these days is actually university students spinning out companies out of the research that they're doing at university, leading university labs. Um, Certainly, there's a fair, and they usually team up with kind of an experienced group of folks from the industry side to help them establish the business and then eventually grow the business and step through the various stages. So how do you get access to those markets, and how do you get the knowledge? So I think you may be aware, and I don't know if you've discussed this, but back in 2012, 2013, there was the Jobs Act in the US that kind of democratized a little bit of this private sector, private sector, especially like early stage company investing. The whole crowdsourcing movement around startups kind of started at that time. Um, the infrastructure for being able to invest in all of that has been set up over the past now decade plus, and there are people participating in those markets, through various platforms like AngelList, Carta, etc. And so a little bit of your, you know, riskier capital that people have appetite for, and in trying to make that sort of big bet in the next big technology leap. A lot of people are accessing private markets for that. So you could think about a company like SpaceX, for example, which is the one that gets a lot of attention. It's still a privately held company. um, Obviously there were people who got access to making investments in that bet very early on before it ever hit public markets.
Right, and when you're in the private markets, you really just have this exposure to innovation that you may not be able to realize when you're in the public markets. Like you said, in those very early stages where it's college students out of a garage, which is the founding story of so many of these now huge tech giants. Um, and that's just something that you won't be able to break into, like you said, without that structure, without that without these ways to break into the private market in place. I
Yeah,
guess,
exactly.
yeah. How I guess how did your early career inform like your approach to venture and alternative investing in
Yeah.
general?
Yeah. So, I mean, I think, yeah, the number one rule in investing is always invest in the things that you know, right? And you
Mm.
understand. So, um, I think part of the advantage that I have is having sort of gone through that journey of, being in a lab and trying to get things to work, and then being in production lines, being in process environments where you're essentially then deploying these products that you're working on at scale. So that hands-on experience for me was very important in terms of understanding the steps required, the the risk profiles that you have in those very early stages, right? So at at the end of the day, what you're trying to do is stop and not make the same mistake twice. So what I would say is experiential learning is super critical, so that you manage the dollars that you get from the investors in a very responsible way when you make those investments, right? We have our stakeholders as a venture fund, our LPs, who trust us with the dollars that they give us. And you know as long as they understand that the risk profile is high, our job is to make sure that the dollars are spent in a responsible, impactful manner, right? And hopefully get to a positive outcome. So a lot of my industry experience and also government focused experience as well certainly contributed in a big way in terms of how I select and manage the investments once we make that.
And the way, and just to touch on that, and maybe you can give us some insight.
Yeah.
Is it true that you can mitigate some of that inherent risk just by the way the fund is structured? And that's as I understand it, kind of what your role would be is to make sure the fund is structured in a way where you are mitigating as much risk as possible. Is that right?
That's correct. I mean, so usually with anything, there's a diversification strategy at the fund level as well, right? In terms of number one is going to be the sort of the breadth of technologies that you uh, take a bet on. So, for example, if in our fund strategy, let's say we wanted to invest in a semiconductor company, um, we may only invest in one as opposed to 10, right? Um, then we would invest in something that's related to uh, that industry, that is perhaps an infrastructure play, perhaps on the power side. And the reason why I'm bringing up those examples specifically is there's a lot of talk around data centers and AI these days, right? And a lot of
Mm.
investments happening in that space. So if you think about the logic, the diversification logic there is not only do you invest in sort of the core technology, which is the chips that on the hardware side that's delivering this, but then you want to have plays that are investing sort of on the software side that may be a shorter time frame to returns, right? And then you also want to invest in the infrastructure that's actually delivering power to these systems, so you can actually generate the output. And so by diversifying your portfolio, so you have bets across that value chain, um, you you can kind of mitigate the risks, and each of those have different profiles in terms of the type of returns they can also get and when they can get them.
That's awesome. Yeah, and I think that kind of leads me into my next question, where I think people inherently have this idea of venture capital, and they think that venture returns are largely just like, for lack of a better word, just like a lucky outcome. Like you just found
Hmm.
that one, and the one in 20 companies that just absolutely exploded. But from your experience, maybe you could give us a better insight of what actually is driving these returns in robotics, embedded
Hmm.
systems, and the related deep tech sectors that you've been involved in.
Yeah, I mean, I think as with everything in investing, there is obviously luck and timing involved in a lot of this stuff, right? I mean, so if you I'll give you an immediate example. So there was a fair bit of investment in the fiber optics space over the late 90s, early 2000s because of data because of the IT boom, right? Um,
Mhm.
a lot of those investments initially failed, right? And people lost money, but the core investment by itself on the infrastructure side eventually paid off. 6 8 years later, when a lot of our streaming services and cloud-based services went on. So part of how you want to think about it is, number one is, does it make fundamental sense? Um, is so if you look at the current boom, at the end of the day, again, I would say um, something like power infrastructure, there's lots of demand places, right? People need power, right? And power can be used for electricity, it can be used in industrial facilities, etc. So if you invested in a company that's actually serving uh, multiple customers, or has the potential to serve multiple customers, because that's what's going to improve your probability of success, um, then your risks are hedged a little bit. That's still not necessarily a guarantee, because part of the challenge and why this stuff is risky is because there's a fair bit of science and engineering that still goes into launching these type of products. But if you have an understanding of how it's done on the industrial side, so if you have the right VCs with the right operating experience, that can help you mitigate some of the risks associated with investing in that, because those folks can, they have the experience to back up, to basically say this is what's potentially going to work, this is what's not, right? And so I would say, as an investor, and great thing is, in this day and age, there is so much information out there. AI tools are becoming more and more sophisticated. I think I think individual investors have the ability to research a specific space and ask informed questions to the venture funds that they've even thinking of investing in, so that they get a better sense of, hey, how have you thought about this? About, what are the markets, etc. So doing a little bit of your homework up front with the tools that are now broadly available, along with selecting venture funds that actually represent operating experience in the fields in which they are actually investing in, I think are two important ways in which you can hedge some of the risks.
Yeah, and like you said, just the technology that we have maybe even, makes it more inclusive for people who maybe have a little bit of working knowledge, but can really supplement the rest of the knowledge that used to be required by using AI tools and really, doing that research. And like you said, you can't only, it's not only that you can invest in these funds that are supporting this tech boom, you can utilize this tech at the same time to help exponentially um, your understanding and your working level knowledge of these industries and these sectors. That's a really good
Yeah.
point.
Yeah.
Um, so historically, deep tech investing, as I understand it, has been fairly dominated by institutions, family offices, larger corporations. Maybe you could give us just an inkling or some type of insight on who you actually see investing in these funds today, and maybe how that's changed over the years.
Yeah, I mean, I think the profile of people that are investing are still a lot of the groups that you just mentioned, right? So, there's a fair bit of institutional investors, there's a fair bit of family offices. So when someone's raising, especially the larger funds, for example, those are certainly raising a lot from corporates, institutional investors, etc. Right? I mean, those are I would say, the 500 million plus funds and above on the venture side. um, and for folks like us who are kind of in the smallish to mid-size game, family offices, foundations, and certainly high net worth individuals as well are the type of people who are generally investing. And as I mentioned, in the Jobs Act, there's two qualifications. One is for accredited investors, and one for non-accredited investors. And so that essentially makes sure that the type of stuff that you're going to see is going to be based upon sort of the your risk tolerance and also the investable assets that you actually have, right? So you don't take outwardly too risky a bet. So for the groups that are perhaps in the lower end of the high net worth, or getting to the high net worth side and want exposure, the most popular way is doing angel investing through some of the platforms that I mentioned earlier, right? And that is available. So I'm sure people have seen certain crowdsourcing things. The key thing is, I think, working with advisors like yourself to make sure that it's on a credible platform, um, and that things are then managed in an appropriate manner.
Yeah, absolutely. And our clients, really what we're advising them on, what we're creating for them is structures that allow them to utilize their retirement capital to be able to invest in these alternative assets. So we work all day and all, I would say all day and all night, but we do take some time off. We work all day on helping investors really unlock that retirement capital. And a lot of investors don't realize that they have this capital in their corner that can be directed towards these alternative assets, these private markets. Um, um, but again, it has to be the right structure. It has to be, this compliant legal structure that is set
That's right.
up. Um, as you've been in this market, how frequently do you see people using their retirement funds, or do you see retirement capital being coming through those channels at all?
Yeah, I mean, I think I'm slowly seeing that a little bit more. I mean, it's I think, your so obviously there's some moves now being made to make 401ks and IRAs you know be able to access those private markets. I would say, we're in the very early days of being able to do that. I mean, and perhaps you'll see even some of the larger institutions kind of offering that option, right? I think the um key issue with that still is, understanding risk profiles and understanding exactly what you're getting yourself into. I think that's the part that I'm not quite sure is there yet. And it will take some time, because if you think about it, it's, you see something listed there. Perhaps it's a bucket of, venture capital funds, right? I mean, so you say you put in some money and you say, hey, here's a venture capital bucket A, right? And that underneath that, there's probably like 3 or 4 funds that you're actually putting in. I think doing a little bit of research on what those funds are, where they've invested certainly, and all of that, still takes a little bit of time, right? And and
For
and
sure.
so I think that's where some of those issues from a compliance perspective and things like that has to be sorted out. In the interim, um, you know, you can potentially just work with, again, a financial advisor like yourself, and figure out, what's sort of the best way um to invest those type of dollars, through some of the platforms I talked about.
Yeah, and in your view, as you are seeing more individuals maybe invest in these private funds, um, for all the people that are still on the sidelines, do you think that we're seeing those people maybe be more hesitant because of a lack of education, or is it lack of interest? What do you think is keeping people, stuck on the public markets? Not that they're bad. I mean, they work in
Yeah,
their own right,
yeah.
but this ability to diversify is really powerful. And why do you think? What do you think is keeping people
Yeah,
from
I
being
mean, I
able to
think
do
I think
that?
the risk. I think not understanding the risk is a legitimate thing, right? I mean, are you dealing with legitimate funds? I mean, for lack of a better term, I mean, are you investing in a scam? I mean, I think those are all sort of legitimate concerns that people should have, right? So doing your homework around the compliance and making sure that those funds are compliant. I mean, what other investors are taking the money from? Are they what their expense ratios are they are their financials being audited? All of those kind of things that you get, right, when you're investing in a publicly traded company. You have a certain level of confidence that there's no there is the audit, the compliance, the governance and compliance is in place for you to confidently say, okay, um, if when they throw out numbers, their quarterly earnings, etc., it's something that's credible and believable, right? I think in the private investment space, um, obviously, especially if you're investing in venture and things like that, you need to understand sometimes you're investing in pre-revenue companies. So what you have to have some understanding of, okay, did my investment you know actually deliver, or is it delivering an IRR, right? And the only way you can kind of understand that is by peeking under the hood and making sure that the funds that are reporting are actually reporting in a credible manner on a credible platform where those numbers are properly vetted.
That's interesting. In your experience, what would you say what would you say causes qualified investor? Let's say somebody is qualified, they're in the know, they've done their research. What causes investors to hesitate or drop off during the investment process, even when they want exposure to this space?
Yeah, I mean, I think more often than not, it's usually um, number one, they may not fully be convinced with the story around the markets and the market potential, right? I mean, I think the second thing is obviously, um, the one thing that we've run into fair bit is valuations, right? I mean, so you if you think about the early stage venture, it's all about there's a lot of attention to, are you getting a good deal on that early price per share that you're investing in, right? And so what value are you getting? Because if you think about it, you invest in something that's already at a kind of frothy valuation. Um, then the uptick, the 3x, 4x uptick may be more challenging, in subsequent rounds. So people,
Mm.
the more sophisticated ones will look at those numbers, the financial numbers, and the timelines that it might take, right? Because again, hard tech investing is not for the faint of heart. Um, it's 5+ years at the minimum in terms of the journey before you get your money returned to you. It could be up to 10, right? Because a lot of times that's the period where it's optimized, and the math works both for the investor as well as for the venture firm as well. That's making the investments on their behalf. So they have to get those pieces also sort of matched up. The alignment in terms of um, what type of return you need, when you need it, and making sure that you're aligned with the objectives of the venture fund principles as well is important. And those can be reasons why things fall off, right? So besides just the company fundamentals, it can also be sort of at the fund level, making sure there's alignment on all of that.
Right. Yeah. Doing your due diligence, and making sure that everything lines up, and maybe finding that there are a couple points that you're not comfortable with or that you
Yeah.
don't align on. That makes a lot of sense. And just to touch on something that you mentioned, with a lot of these tech funds, tying up your money for multiple years at a time, that is where we do see some advantages of using retirement funds, where this is already capital that has restrictions on when it can be pulled out or when you can touch this money.
Yeah.
um, it's really more patient capital than maybe your
That's right.
personal fund. So that's where we do see a lot of investors being able to utilize their retirement funds, even in this fund where it may be a 10-year life, a life cycle for the fund, but maybe they don't retire for 11 years, so they see those returns before they're even allowed to touch to touch that capital. But that's one thing I think that is kind of overlooked, as far as retirement capital goes within these private markets, is um, kind of the advantage of, I guess, not even the advantage, but just the similarities in how your funds are locked up.
Yeah, I mean, and the other way to kind of look at it also is, I mean, obviously retirement, you know, capital, as the name suggests, is for the things that people need, once they've retired, right? But there is a
Mhm,
fair bit of that capital also that people have sort of in anticipation that they want to hand it off to the next generation.
mhm.
And if you then look at it from that time period and that generation's ability to sort of recover if they're, if certain things don't go right, um, I think there is a little bit of that element. So I've been thinking about that a little bit more in terms of, because there's people talk about the great wealth transfer that's going to happen and things like that, and I mean, I think obviously the younger generation that may have a little bit more of a trajectory, of now 20, 30 years before they retire. I mean, for them, getting them involved in a little bit of that and giving them that exposure, through the retirement funds you have, may not necessarily be a bad thing. I think so that's another way to view this is, okay, maybe there's a pool of money that you really need and you want it to grow kind of in a steady manner, but then maybe there's a little bit of risk capital there that you want, in terms of leaving a legacy for the next generation. And maybe that's the type of stuff that you look at, and you look to make investments in more of these private markets.
Yeah, and that's the great thing about the structure, like you said, is it gives you the option, it gives you the platform and the structure to be able to strategize in that way, right? Where
Yeah.
if you were just solely dependent on the public markets, that may not be something that you could as aggressively pursue, right? So I
Yeah.
love that point, and I think a lot of investors do want exposure to the private assets, and they do. They mainly just worry about doing it in the wrong way, especially if
Yeah.
they're thinking about using retirement funds. But even with personal funds, I think a lot of people have that hesitation. Um, do you think, from your vantage point, what are some common, I guess, compliance pitfalls, mistakes investors make when they're trying to participate in these private deals?
I think number one is making sure that you do the due diligence on the fund, right? Making sure that you have a trusted person who's auditing all of that. So that's sort of on the financial side, right? So I always look at these things
Mhm.
as, um, and even when I'm investing, I'm looking at at the team and the financials and the legal compliance in a very close way, right? Because it's the same deal. So if you're investing in a venture fund that then investing in companies, you want to make sure that you kind of look at the same things to start out with. So do your homework, do your reference checks. Those are going to be the big things. On the people, on the fund, on ensuring that they're compliant, all of that, I think is a good starting point. Then, at the same time, assuming that they are also investing in spaces that you think would be of interest, and something that you understand, or you can work with your financial advisor to better understand, um, would be the other sort of parallel path that you want to take. So if that piece kind of falls into place, then working to make sure that all of the compliance stuff is all in place, the combination of a yes and yes on those attributes can then be that, okay, let's put in a little bit of risk capital here and see where things go. you know
Yeah, I love that. For your fund personally, for Prithvi, uh, what are you looking for right now? Are you in a raising mode? Are you building mode right now? What are you looking for
Yeah, so
with
we're
your
doing
fund?
both, right? So there's parallel activities going on. We have 30 plus companies that are in our original fund, and we have another, I think, about 5 years left on that fund. We've already returned a little bit of capital from that, with a couple of companies going public. So Amprius, a battery technology company, is publicly traded now. We had we had Voyager Space as well, Voyager Technologies in the space side, that's gone public, and then on the private side, got acquired by NVIDIA. Grok AI
Mm.
uh, was so now we have a smattering of another 20 plus that we are at different stages of their journey, and then we're trying to figure out how to get them the requisite follow-on capital, etc., to help them scale the business, right? So and we are actively managing, but separately we have a thesis for fund two around kind of investing a bit more around enablers for the next generation of industrial manufacturing within the US, right? As hopefully manufacturing takes off again in the US, and so we are actively looking for LPs for that fund, and we also have a fair bit of deals that are in sort of the pipeline, ready to go if we can get the right commitments. But I think one of the things for us as well, uh, we look at these things as a partnership. So we want to be investing in the right companies, but then vice versa, we want to be also investing. Also want to be taking money in from the right type of LPs who
Yeah.
are sort of mission oriented and culturally aligned with the type of things that we want to have accomplished. So they need to have a good understanding of what they're investing in, and what the timelines are and things like that they're investing in. And that makes it a little bit easier for us then to manage that relationship. Because ultimately, with all of this stuff, it's all about trusted relationships, right? And
For
so
sure.
and ensuring that there's an alignment in terms of the value system up front, on both ends of that, with our stakeholders and then with the companies that we invest in, is super important. So we are looking at fund two, and we have a target for that, roughly. So our first fund was a little over north of 30 million that we invested It's about 2x now on book, along with some capital that we've returned, right? But yeah, so we'll be probably targeting, closer to 100 maybe, for the second fund. We are in the process of looking for the right investors for that.
Awesome. And for any LPs or potential LPs out there, what are the minimums that you're looking for an LP to get in on the ground level?
Yeah, I mean, and that's a good question for Kunal. From what I've heard, and I've seen, it's usually about 500K.
Okay.
But there's and this is something that people can look out for, just in general, and this is just not a Prithvi statement, but in general, when you're on those platforms, there are what SPV, special purpose vehicles, as well, and some of those, when it's a super early raise, you could be investing in an individual company, and sometimes the check size may be as low as $10,000.
Wow.
Yeah,
And yeah,
so
that's for most, I think, investors, especially investors using retirement capital, I think for the SPVs, that's a more attainable,
absolutely.
capital call for,
Yeah, so
yeah,
we
for
do
the
we do
average
we do a
retirement
mix,
plan.
right? So for our fund, so there's a fund pool, right? So that's kind of for the accredited folks who have sort of the risk appetite and the ability to contribute.
Mhm.
And then there are occasionally sort of super early stage, this is the spin out of a university. People still have to figure things out. They need the first, uh, you know, $200,000, and there may be 10, 20 investors who are contributing to that.
Yeah, and just another tidbit for people that may not know who are listening, but if you are an accredited investor and you've ever wondered if that title or that status directly applies to your retirement funds as well, it does. If you're using a self-directed IRA, solo 401k to invest in alternative assets, your structure will inherit that same accredited investor status. So if that's something that's been keeping you out of the out of these alternative assets, out of these private markets. Just have that information. Wanted to mention that as well.
Yeah, so I mean,
Um,
for me personally, like that's what I have an LLC, and my LLC is what invest, but from an accredited investor perspective, yeah, they just look at the pool of funds available for myself as an individual and the LLC, right? So
exactly.
to
Hmm.
then get access, and so in theory, I can then be investing in interesting deals on the platform that I'm in.
Yeah, for sure. Um, so I guess looking more towards just from your experience, what your vision is for the future. Looking ahead, I know you're not a, you don't have a crystal ball or anything like that, but just if you had to guess, looking ahead 5, 10 years, do you see more capital moving into private markets from individual investors, individual accredited investors, rather than the traditional family offices or larger corporations?
Yeah, I think more of that is going to happen. Like I said, I think in the process of this wealth transfer we talked about, I think there will be that. And honestly, if you think about public markets as well, right? I mean, they've gone through that when retail investors got more and more comfortable with the information that was available. I'm certainly more active as a retail investor myself in public markets as well. Now that the information is kind of at your fingertips, right? I think it's more familiarity more than anything else. I think people are less aware of the platforms that exist now to do private investments, but I think the awareness is certainly growing. I mean, if you look at the valuations of some of these companies that are privately held, there's very clear indications that more and more people are becoming aware uh, of this. So I expect that trend to sort of continue. As I think, also, I think sometimes they may have trusted banking relationships and things like that, and advisory relationships, and as those folks also get more comfortable and are offering it up, I think the familiarity keeps growing.
Definitely, yeah. Definitely as your knowledge increases, I mean, knowledge is power. As your knowledge increases of it, I think we're in the age of, the most accessible knowledge ever. and it's only going to get, it's only going to get better. It's only going to get
Yeah,
faster. It's only
and the
going to get
data
more
is out there.
efficient.
And I mean, the great thing is that the data is out there. Those platforms are kind of really tracking. Carta, for example, and other platforms like them actually give you a pretty good understanding of things like, hey, yeah, there's different levels of venture investing, right? Like you have the pre-seed, the seed, the Series A, B, C. It can seem like a lot of jargon for especially investors who have never done that, but you know, working with a financial advisor, you can actually get a pretty good understanding of um, what's going on there, at what level, what valuations you're investing in, what's the possible returns you can get. And then there is, now 10 plus years of data that's kind of showing what the typical returns have been for different sectors and things like that. So that knowledge base is now being built up. So you can envision in 20 years, there's going to be 20 years plus of data that gives sort of the individual investor a little bit more comfort, right, in terms of how things have been performing in those markets. So I think there is that cumulative effect. And to your point, I mean, the AI tools then also help you get to another level of comfort in terms of the type of profiles. I mean, you can do the research on, the companies that are spinning out, which research groups are they coming out of, right? I mean, and what's the track record of the people? All of that can now be researched with AI tools. You don't really, which again, if you think about it, even 10 years ago was very difficult, right? Even 5 years ago, I would say, right?
Yeah.
So, yeah, I mean, if someone is interested in investing in Prithvi, they can pretty much do an AI tool search of myself and my partners and know if, these are people who appear to know what they're talking about.
Put it to the test. Yeah. I love that. If you were, Rakesh, let's think of a hypothetical here. If you were talking to a serious investor today,
Yeah.
and they were interested in getting outside of the public markets into these private deals, where would you suggest that they start building exposure outside of public markets? What would
Yeah,
be that
so
first step?
start out with the platforms that have been set up for that. So AngelList and Carta. There is a ton of literature out there now on venture investing, and sort of demystifying venture investing as well. And so those are all very good starting points. I think anyone who's made investments in public markets can very quickly understand sort of the parallels. It's not this big, invisible hand unicorn type thing and mystical thing anymore in terms of an asset class, right? Venture and private equity. I think there's a lot more information out there about the type of investments that are made, the logic behind making those investments, and how they actually get returns and things like that. So that's where I would start. So start with the platforms, do your research around, different sectors, what the venture returns have looked like over the past 10 plus years, and that can give you sort of an initial comfort level in terms of, oh, okay, this is what I'm actually getting myself into. Then work with a financial advisor like yourself, who they trust, to then say, okay, all right, I'd like to do something like that. Hey, Nick, how do I get this exposure? Am I doing sort of the right things in terms of getting a little bit of that exposure, right? And that's kind of step two.
For sure. Yeah, I love that. Rakesh, this has been incredibly insightful, I think. For listeners who want to learn more about the work you're doing at Prithvi, or for operators looking for capital, where should they go? How can they find you? How can they get in contact?
Yeah, so I mean, I'm on LinkedIn. That's the easiest way to reach me, and I get a lot of inbound that way. Uh, my email address is pretty easy. It's rakesh@prithivc.com. I think you have it, Nick. And yeah, I mean, that's usually the ways in which people get in touch with me. And usually a lot of our referrals also come through trusted networks of people that we have, right? So people inquire that way too.
Awesome. Well, Rakesh, thank you again for your time today, giving us the benefit of your insights and your experience in this industry. Really appreciate you today. Any last words of advice for our listeners? Your favorite quote? anecdote, anything like that you'd like to share with us?
Yeah, I mean, I think, as with everything in investing, I would just say, um, and this is what we use when we screen. Um, we first invest in the team, and then that team's ability to bring in the right customers and then the right investors. So I think when you're evaluating who you want to work with on the venture investing side, the people side of the business is the first thing that you look at, making sure that you're comfortable with the type of people that you have, you're going managing your money and then sort of investing your money in these type of markets. And then also second to that, understand this is still risk capital. It's so only invest the money you feel like you are able to be patient with. And some, the hit rates are still 8 out of 10. No, I mean, 2 out of 10, right? So eight fail to, one or two succeed, but those one or two may be the unicorns, and now people talk about decacorns.
Definitely. I love that, Rakesh. Thank you again. Uh, check out Rakesh on LinkedIn. Go to the Prithvi website if you're interested in looking out. We can leave all that information in the comments. But thank you again for your time today.
Thank you, Nick.